Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from the city of brotherly love, Dimitri Pagamonik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And let me share my screen while I'm doing that. If you guys are joining us for the first time, Will and I do this show in the mornings to help answer questions you may have about Market Chameleon tools, data, or analytics. If you want to come on the show and ask your question live, we provide a link to Zoom on that live chat on YouTube. Click on that link. It takes you over to Zoom. Once you're in Zoom, click on the button, raise your hand. Once you do that, we'll let you in. Everybody could hear your question. You could direct us to where you're looking at. You don't have to turn on your video camera. If you prefer to type in your question, you could also type that into the box on YouTube in the chat box. Will's watching it. He'll read them back to me. While we're waiting for questions to come in and more people to join us, we'll start out looking at the pre-market report to get some insights what's happening in the pre-market hours. I could also default to some questions that I get over the emails or the chat that I think, if when I hear some either interesting question or things that I see questions kind of repeat, I'll try to default to those and talk about those. And I did get one interesting question I think is worth talking about is tail risk. So maybe we'll talk a little bit about that today, and if questions come in, let me know. We'll try to get to those too.
All right.
So pre-market report, these are stocks trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. And down here, I see 52 stocks made our percentage gainers list, 184 in the decliners. So from this perspective, right now, we're setting up for a bearish bias at the open. If you look at this list, you'll see that there are a lot of leveraged ETFs in here, other ETFs, small cap stocks. There could be closed-end funds in there, preferred stocks. So pretty much anything that's listed on the major U.S. exchanges, if it's trading in pre-market hours and meets our thresholds, it can make this list. So what we want to do is narrow down this list to a smaller group of stocks to get a more focused insight. And to do that, I'm going to use the filters up here. And the filter I'm going to use is this one, in ETF. When I click on it, I get a drop-down menu, and I get to select from a list of different ETFs. You could see that there are some sector ETFs in there, some broad-based ETFs, and this one up here, SPY, that's the S&P 500 ETF. Let's select that. And when we do that, the tables below will get filtered by stocks that are holdings in the SPY ETF. And here we see that 3 stocks made our percentage gainers list, 52 in the decliners. Again, from this perspective, right now, we're setting up for a more bearish bias at the open. And obviously a lot of news out there, almost now daily. We're hearing about, bank stress and some tightening in the credit markets. So that's starting to create that volatility in the marketplace. And, right now the stories are, I think this one, that's first, the bank, what is it? First National?
First Republic?
First Republic, right. First Republic. That's been on the news, after that SVB. So that's down 4.5% today. So let me see if there are
we did have a question from a new chameleon who is
Okay.
on for the first time today, Fred, and he was asking, why do you think the VIX is so low, question mark? And then he goes on to state, could the increased volume in 0 days to expiration options not be reflected in the VIX? Those are
Yep.
two things
Yep.
you mentioned.
Yep. Yep. Thank you. That's a good question. So why is the VIX the the fear gauge or the premium, in the equity markets not reflecting, the what else is going on, in the economy and especially in the bond market and given like what's going on in the financial sector. So we'll take that, and what I'll do is I'll use that also to talk about the tail risk. So when we talk about the VIX, in our version of the implied volatility is the 30-day constant maturity, right? So this is going out, and when we talk about implied volatility, you do have to reference which implied volatility are you looking at, because implied volatility, it's not something, like a stock price where here's a trade and we know the stock price value. Implied volatility is a derived value from option prices. Okay, so when we look at option prices, here are option prices, here are calls, here are puts, and each option price will have its own implied volatility. Okay, so you could see here, just here, how they are different depending on which option you reference. Okay, and the 30-day IV, the VIX is a 30-day constant maturity. There's a formula to it. It looks at the option prices in the SPX. It's a weighted average between expirations that straddle 30 days, and it gives different weightings to different options. You could look at it yourself, and it tracks that benchmark, that calculation. And ours is kind of close. We look at the monies. We don't look at the wings in our calculation. And I'll explain actually today what the difference is and why. Because somebody did bring up a good point. If you're trading wings, you're trading 10 delta, 5 delta options, should you even look at implied volatility? Right? Is implied volatility even relevant for that option? That's a really good question, because I think that what I've seen are people who do want to go out and sell out of the money puts, deep out of the money puts, thinking, well, they're so far out of the money that they don't, there's a low probability that the stock will break through that strike price. And then they look at the implied volatility of that option. But is that even an appropriate way to, value that option if you're trading a 5 delta, 10 delta wing? Is the implied volatility on that wing, is it even relevant? Should you even be looking at the implied volatility, or is there a different analysis, being applied to wings than options that are around at the money? And so that's an important question. And I would say that if you're looking at an implied volatility of tail risk, you're probably not going to do well in the long term. If that's what you're trying to do, is look, if you think you're trading implied volatility by selling tail, then you're probably not understanding fully what implied volatility is. And that's been proven, by the way, over the course of many years. Long-term capital tried to, do that same strategy of, looking at the implied volatilities and selling the wings, and they had needed a massive bailout. And that's why we have a skew. But we'll talk about that and I'll give you some examples. But first, why is the implied volatility, low, given, that there's greater uncertainty in the markets, in the banks, the interest rates are going up. And right now, the implied volatility, as we see it from the at the monies, is not signaling, the same thing the bond markets are. So let's just take a look at the bond markets. If we look at the bond markets, the yield curve, they're giving us a signal. Like here's the 1 month right now treasuries, let's say is 4.3, but you could see how they fall off. 2 years 3.8, 10 years 3.4, and what they're indicating is that, well, interest rates are the bets are that interest rates are going to come down. That's what over time the interest rates are too high and they're going to come down. And if you really look at the average yield here, for 2 years or 10 year, they're betting that at some point, the interest rate's going to have to go even below this on the Fed funds, right? And people look at that saying, well, that's signaling that there could be a recession on the way, which warrants the Fed to lower interest rates, or deflation, which the Fed will lower interest rates. But if this is the case, that's the case, if we're headed into a recession or a hard landing, how this is suggesting, then we should see risk premiums in the equity markets, right? If there's a recession, let's say there is a recession and that companies' earnings growth is going down, companies are going to have to lay people off. It's going to be harder, to generate profits. If all that is if that's the forecast, right? If that is the forecast, then we should start seeing that reflected in the equity risk premiums. That means how's the stock market going to stay up? How are companies going to continue to make the same profits and grow at the same rates if the economy is forecasted to go into a recession and do worse? Right? That's the question. There's a big dislocation right now, big disagreement, perhaps, of what the bond market is signaling and what the equity markets are signaling. So let's take a look at, when we talk about the wings, let's look at the risk premium for SPY. So here's SPY benchmark S&P 500, and let's go out 120 days from now. I'm going to go out 120 days, and let's look at a put option, 10% out of the money, right? So what is the cost of this put? Forget about implied volatility. How much is it going to cost me to buy protection that if we tank more than 10%, I'll take the first 10%, but if we tank more than 10%, what is it going to cost me to protect my position in equities? And what did it usually cost? What does it cost today? And how much did that go up? Because if the fear of recession is coming up in the next 120 days, then the market is going to start moving down, right? The market, that means earnings are coming in, companies are going to make less profits, equity prices are going to go down. So what are the option markets telling us? Are people buying insurance? So let's regenerate that. We're looking 120 days to maturity for the cost of the put, 10% out of the money, right? Let's generate that. So here's the cost. So as this line goes up, the cost goes up. As it goes down, the cost is lower. So right now, it'll cost you 1.2%, right? So 1.2% of the, your principal invested, 1.2% to protect your position below 10%. Right. So think of it as like insurance on a car. Your your deductible is 10%, then your insurance kicks in, and it'll cost you 1.2% of the spot price. But you could see here that's not elevated because the average for the last 52 weeks was 1.9%. So that's still, we're way below the average, and we're really on the lower side. It's not the lowest it's been, but it's still on the low side. So the equity, the prices in the equity markets, they're not signaling that we're, or at least for now, there's no signal that, hey, people are starting to hedge and push up that insurance because they think that there's going to be, a wave of selling going on. And we could also take a look at the open interest. Let's go to SPY, because this SPY is the most traded, security right now, usually, either the top one or in the top three. And let's take a look at the open interest here. So this is the open interest in SPY, and this is going out in time, right? So all the way out here are leaps, right? These are longer dated options. This is December 2023. You got January 2024, June 2020. So even going out in time, let's say the markets don't expect, a sell-off in the next month, 2 months, 3 months. But here, we've got very long dated options here. Very long dated options going out in SPY, going out years, actually. This is here it goes out to 2025. Right. So now we're going out to 2025, and we don't see that people are going out there and increasing positions to hedge, even going out further in time. Here, right now, April, right? April has the highest open interest. There are more puts than calls. But even though there's high open interest, April would cover the implied volatility here. So this, whatever this open interest is on the, on the board, that itself isn't indicating fear because it's not being reflected in the option prices, right? Because if all this open interest were actually just put buyers, we would start seeing that the cost of that put would start increasing. We didn't see that, right? We just looked at going out 120 days, which would have covered this. And if a lot of this was in a build-up in put positions, buying put positions, we would see the cost of it going up, but we don't. So the equity markets right now are not pricing in, a major sell-off, if we look at it from an options perspective. And it's a good point, why not? Why are the, what's going on in the treasuries? Why don't we see correlated in other markets? And there's a dislocation right now. And I think that there's just uncertainty going on. And there's really no, reason yet to sell off the markets because we're still at full employment, right? And
people are talking about rates coming in, right? Like the Fed may actually lower it.
Right. So we're still at full employment. It doesn't look like we have a leveraged bubble, which are the worst, so when people are, if you look at, there was a bubble that kind of popped in the in the coin space, in the digital tokens, but it wasn't on leverage, right? It wasn't where people were in general, right? There's some people that may have, but it wasn't on a leverage where, because once you do it on leverage, that it impacts it starts to cascade, right? Because then the people you borrowed from get in trouble, and those other people get in trouble. But it wasn't a leveraged bubble. It was more kind of like, it didn't spill over to other parts of the economy. It was kind of contained within the space of those people who were engaged in that. But we don't see really that much leverage right now. And the leverage that was built up in the housing market, I would say that this time around, the loans that they were making were better loans. They learned from 2008. They were not just lending out no doc loans or giving people mortgages that couldn't even afford those mortgages. And they were done at low interest rates. So they were locking it in at very low interest rates. And so we don't see, right now, this leveraged bubble about to pop. SVB Bank, they got into trouble. They were servicing kind of like a less diversified, depositors, where, a lot of their depositors needed to access capital during this period, right? So basically they were servicing the startup community. So that is part of why they got into trouble, but not every bank does that. And right now, we don't have, a lot of fear and really a stock market sell-off being priced into the options markets. So it's a good point. I can't tell you why exactly. You could just take a look at the observations. But so far, as far as like the stocks go, the economy hasn't shown, signs that we are in a recession, because we're still at full employment. The earnings are decent. The companies are starting to adjust, because you do see, layoffs from companies that overhired. We had that from Meta. We heard that from Coinbase. And they're starting to act responsibly, financially responsibly, and adjusting to the reality, that it's not hitting the equity markets really yet. The other thing is, I think there's a fear of the Fed cutting interest rates. And when there's a sell-off in the stock market, the Fed cuts interest rates quickly, maybe even goes to zero, and then the market reinflates really quickly, right? I think there's a bigger fear that the Fed may come out and just one day say, we're going from 5% down to zero, and the market is going to explode that day, right? And I think that there is that fear in there, that if I sell my stock and I miss it, it could be up 10-20% in a matter of really quickly, in a week or whatever. It will go up really quickly if that happens. So that might be also fear in there, to sell stocks. As far as the wings, let's go back to the wings here. And implied volatility, when we look at implied volatility, it comes from a option pricing model. And this option pricing model has assumptions in it, okay? The assumptions are that you're going to trade the option in a matter where you have the option on one side, and then you have a stock on the other side, and you're going to trade the stock volatility against the option implied volatility. that's how the option pricing model works on that assumption. And based on that assumption, they say, okay, well, that if you do that, the implied volatility in this option, right, is 30.7, let's say. So if you trade the volatility in a stock, right, against the implied volatility, then it's kind of like you're trading implied volatility versus realized. This is how the Black-Scholes model works. It's not really, it values the option based on that model, that you're trading a strategy in a certain way. Not that you're just going to buy the option and hold it or sell the option and do it. It's looking at what is the realized volatility versus the implied volatility. And when we go out to the wings, right, here are the wings, right? Let's just take a look at these. So all these, you see these for a penny, they have an implied volatility. But that implied volatility at this point is meaningless, because when you're going out to these lottery tickets, where the option is so low, it's far out of the money, it's low priced, then you're not really going to trade that gamma. You're not going to trade that option like the Black-Scholes model assumes, right? That basically, that option is really a tail option where it's saying that if the stock goes down, it could go down so fast that the normal distribution of volatility doesn't even hold, right? Because the normal distribution says that these options aren't, the way the stock moves, it would have to move so fast that it doesn't matter what the assumptions are in the option pricing model. That's not the way the stock moves. It's just going to go down really quickly. Let's take a look at SIVB, for example. The stock basically, right, it moved down to zero, right? So it moved down really quickly. And if you look at the implied volatility, or even the historical volatility, right? Here's the historical volatility, the line, purple line, 20-day moving average, and that's the implied volatility. So that, if you're trading the implied volatility, just using, implied volatility forecasts, then this would never have helped you in the situation where this basically went down to zero really quickly. You understand? So you would have never been able to price that tail risk using implied volatility or historical volatility, because what happened was that the stock unexpectedly just deteriorated, and the volatility didn't matter. It just went down to zero, right? And that's why the tail risk is much different, because implied volatility tries to measure the fluctuation in stock prices around the current price, right? So it takes the current price and says, how much is it going to fluctuate up and down? But it doesn't really work in a situation where the stock moves very quickly from one price to the next. All right, that the Black-Scholes model assumes that doesn't even happen. The Black-Scholes model says that a stock could just like be one day trade at 106 and just go straight to zero, just get halted and go straight to zero. The Black-Scholes model assumes that that's not even possible. It has to trade at every penny basically before it gets down to zero, right? It has to trade at every price at a certain volatility before it gets down to zero. And the Black-Scholes model assumes that a stock cannot get taken over for cash, because that's not volatility, right? It closes at one price and then goes to up from, it could go from 106 to 200. Somebody took it over for cash. So keep in mind, the Black-Scholes model assumes that that is not even possible, right? That does not ever happen. And that's why when we look at those tail risks, you can't really use implied volatility as a metric to say I'm going to trade the implied volatility of a tail option. Hopefully then.
Yeah, that's super helpful, D. Rob had a quick question. I tried to direct him through a link that I thought you could go for it, but he was asking about, can you screen for option volume for ETFs only? How would you do that?
Option volume for ETFs only?
Yeah.
Yeah, I think you could just do it probably from the stock screener.
Yeah, I went to there's actually an ETF screener.
There's an ETF screener?
Yeah.
Okay.
Right. That's what I sent him the link to. And then you can sort by, if you look, there's relative volume, the volumes are there. You can sort by.
Right. So you could use the ETF screener actually. Yeah. Good point. Yeah. Here's the ETF screener. So here are the option volumes on the,
all right. Perfect.
Yeah. All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day. Hope to see you guys Monday. And I think I'm out next week, Thursday, I'm going to Miami. So next Thursday, Friday, and Monday we'll be out.
There are a lot of chameleons in Florida. You may bump into some if you're in Miami.
Yeah, maybe we're going to
actually
be there.
Big spring break weeks. I've heard on the news that spring breakers are going crazy in Miami Beach.
Oh, really? Yeah.
Shut it down last week or something.
Yeah, right before. Yeah, exactly. Right before we go. So yeah, just going out for with the wife, but yeah. So those 3 days we might be out. Maybe on Friday we'll see. Maybe I'll do the show on Friday.
From Miami Beach.
From Miami, yeah.
Ooh, maybe by the pool. Maybe you can get a spot by the pool and do a show by the pool.
If we get questions. Yeah, if we get good questions coming in from email, maybe we'll do one on Friday.
All right, awesome.
All right,
awesome
everyone,
job,
stay safe out there. Have a great trading day. Hope to see you guys on Monday.
Have a great weekend. Thanks, Steve. Bye, everyone.